Today, we are diving into two crucial metrics that every real estate investor needs to understand: cap rate and ROI. If you're looking to invest in real estate, these two terms will come up constantly. Knowing the difference between cap rate and ROI can help you make more informed decisions and avoid costly mistakes. So let's break it down, look at some examples, and figure out when to use each one. If you are new to my channel, my name is Jas Oberoi and I'm a real estate agent, investor, and a serial entrepreneur. I went from working as a server to owning multi-million-dollar worth of real estate portfolio in just 8 years. In my career, I have helped hundreds of my clients buy over 900 million worth of real estate using tried and tested strategies, and I am here to share those tips with you on this channel. Let's start with cap rate, short for capitalization rate. Cap rate is a quick snapshot of a property income potential. The cap rate tells you how much return you can expect on a property purely based on its income generating ability without considering any financing or debt. Formula for cap rate. Cap rate is equal to net operating income divided by property value times 100. Net operating income is the annual income the property generates after operating expenses are paid. This includes things like property taxes, maintenance, insurance, and management fee, but exclude mortgage payments and financing costs. Property value can either be the purchase price or the current market value of the property. I will give you an example. Let's say you are evaluating an investment property with an annual NOI of $50,000 and it is valued at $1 million. Cap rate formula is $50,000, which is your NOI, divided by $1 million, which is a market value, times 100. The answer is 5%. A 5% cap rate means that if you paid a $1 million for the property and manage it effectively, you could expect a 5% return on your investment before considering any financing. Investors often look at cap rates to quickly compare the income potential of different properties in the same market. It helps in assessing the risk, but there are some limitations of the cap rate. Cap rate doesn't factor in your mortgage or loan payments, which can significantly affect your actual return. Ignore market changes. Cap rate can fluctuate with the market conditions, and relying solely on this metric might not give you the full picture, especially in a volatile market. Now let's talk about ROI, which stands for return on investment. This is a broader metric and takes into account your personal cash investment, including any financing. And if you're wondering what the formula is, it's simple. ROI is equal to net profit divided by initial investment times 100. Net profit is the total income minus all expenses, including mortgage payments, interest, property management fees, taxes, and repairs. Initial investments include the down payment and any upfront costs you have paid to acquire the property, like closing costs or renovations. Let me give you a scenario. Imagine you purchase a property with an initial investment of $200,000, including your down payment and closing costs. Over a year, this property generates a net profit of $20,000 after all the expenses paid, including your mortgage too. So remember the formula? ROI is equal to $20,000, which is your profit, divided by $200,000, which is your initial investment, times 100. The answer is 10%. A 10% ROI means that for every dollar you invested, you are getting 10 cents back each year. It's a direct measure of how well your money is working for you. Reflects investor perspective. Unlike cap rate, guys, ROI accounts for how much cash actually you put into the deal. It's a personal measure for profitability. Consider financing. By including financing costs, ROI gives a clear picture of actual returns after accounting for debt. Just like cap rate, there are some limitations for ROI. ROI varies with financing structures. ROI can be heavily influenced by your financing terms. A low interest rate can make your ROI look great, but it might not reflect the property's true income potential. ROI might not always be an accurate reflection of risk. A high ROI can sometimes be a result of leveraging, which also increases your risk of exposure. Key difference between cap rate and ROI. All right, guys, now that we have defined both, let's quickly compare them. Cap rate looks at the property's income relative to its value. It's a property-based metric. ROI measures the profitability based on your cash investment. It's an investor-based metric. Cap rate does not include any financing costs. It's purely based on the income and property value, whereas ROI includes your mortgage payments, interest, and any other financing costs. Cap rate is useful for comparing properties quickly and evaluating the income potential of a property. ROI is better for understanding how well your personal investment is performing, especially if you're using leverage. Real-world scenario comparison. Now guys, let's look at a practical scenario where you might use both metrics. Imagine you're deciding between two properties. Property A has an NOI of $80,000 and it valued at $1.6 million, giving a cap rate of 5%. Property B has an NOI of $100,000 and it is valued at $2 million, giving a cap rate of 5% again. So both properties have the same cap rate, but if you decide to invest in property B with a $500,000 down payment, your financing terms will affect your ROI. If property B's mortgage payments are $60,000 annually and you have other expenses totaling $20,000, your net profit is only $20,000. In this case, your ROI on property B is, again the formula, $20,000 divided by your initial investment, which is $500,000 times 100, comes to 4%. Even though both properties have same cap rate, your ROI for property B is much lower due to financing costs. This highlights why it's crucial to look at both metrics before making a decision. So guys, to wrap up, use cap rate when you want a quick, unbiased way to compare properties' income potential, especially in a specific market. Use ROI when you want to know how well your investment is performing based on the cash you have invested, considering financing conditions. Guys, remember, in real estate, the key to success is understanding the full financial picture. Relying on one metric can lead to blind spots. By combining both cap rate and ROI, you get a clear, more comprehensive view of investment potential. And guys, if you find this breakdown helpful, give this video a thumbs up and don't forget to subscribe for more tips on marketing smarter real estate investments. Until then, see you next time. Take care.